Hello, my friends. Today is the September FOMC meeting, and as usual, I'm going to debrief you as to what happened and what my thoughts are. Now, before we begin, let's level set. The last FOMC meeting we had was in July, where the Fed hiked rates. Now, heading into this meeting, we've had some pretty positive data. On the inflation front, we've had pretty good inflation prints. The last month's inflation print seemed to suggest some acceleration due to energy prices, but overall, I think inflation has been trending in the right direction. At the same time, economic growth has been surprising to the upside. Consumer spending continues to be strong, and the economy continues to create jobs. Of course, not at the same pace as it used to, but that's to be expected as we approach full employment. Now, heading into this meeting, the FOMC had already very, very clearly hinted that they're not going to hike rates. So that was not expected. What people were trying to figure out, though, is what kind of future path they would signal. Now, this being a September FOMC would be an FOMC where the Fed has a new dot plot. The dot plot is basically a document where all the FOMC participants pencil in where they think interest rates will be over the next few years, as well as their view on growth and inflation. It's a way that the FOMC communicates to everyone just what they're thinking. So we pay attention to what the median FOMC participant is saying, because at the moment, that's likely going to be what the Fed does. Now, to be perfectly clear, events happen, the Fed changes its mind, and in the past, the dot plot has been very wrong. But of course, it's the best information that we can have at the time. And unless you have, big changes in the world, it's the best estimate we have. And it's also, I think, been much more right than the market has been over the past several months. Okay, so this September FOMC meeting, again, as expected, the Fed did not hike rates. But in my view, it was surprisingly hawkish. Now, it was hawkish through the path of rates that the dot plot communicated. Now, first of all, the Fed is still sticking towards the guidance that it gave at its last dot plot, which was in June, where they forecasted 2 more hikes since June, and we had one, so it would be 1 more this year. Now, the September dot plot continues to pencil in 1 more rate hike by the end of the year, which could happen in November or December. The market is pricing in pretty good probabilities of it happening, but we'll see. Now, the other thing that I would note about this dot plot was that it revised upwards economic growth significantly for this year. In June, the FOMC was penciling in economic growth this year to be about 1%. Now, from their perspective, trend growth, potential growth of the US economy is about 1.8%. So 1% would be a pretty slow economy, and it was designed to get inflation back towards target. However, what we've seen this past year is that economic growth has been really strong. So the first quarter, growth has been above 2%. Second quarter, also above 2%. Now, keep in mind, 2% is above the potential growth rate of the economy of 1.8%. So according to traditional economic theory, when you're growing above trend, there's an inflationary impact. Now, we don't have data for this quarter yet, but it looks like it's going to be pretty solid. Now, looking at all this recent data, the Fed upgraded its growth forecast for this year from 1% to 2%. It was a very big upgrade. Now, if you're the Fed and you're looking at things as they evolve, you have to begin to be afraid that, maybe the economy is going to persistently run hot, and that makes it more difficult for us to get inflation back under control. So in line with that upgrade in growth forecasts, the Fed also penciled in fewer rate cuts for next year. In fact, it guided towards a rate path next year that had 2 fewer hikes. So in my view, that is a significant change in the stance of policy. So the Fed was thinking maybe we'd have 100 basis points of cuts next year. Now the Fed is thinking maybe we'll only have 50 basis points worth of cuts. And not surprisingly, the market saw this meaningful revision upward in the expected path of policy, and it sold off bigly. So we have the dollar strengthening, again, higher US rates, stronger dollar, not rocket science. We have tech selling off. And I think treasury yields, they were heading into the FOMC, they were lower, and they gave a lot of that back after the press conference. So this market reaction is totally in line with what you would expect from a hawkish Fed. Now, the last thing that I'll note that I found interesting was the FOMC committee's view of what R star is. Now, R star in economics jargon is the interest rate where the economy is neither growing nor shrinking. It's a benchmark rate the Fed uses to try to decide whether or not policy is accommodative or restrictive. So if policy is above R star, that means the Fed is slowing the economy down. And if policy is below R star, that means the Fed is being accommodative and trying to boost the economy. So there's been a lot of discussion over the past few months as to whether or not R star has changed. The Fed, over the past few years, has basically agreed that R star is about 0.5% in real terms. But more and more people on the FOMC, the Federal Open Markets Committee, are waking up to the fact that that's probably not true. Why? Well, obviously, the Fed hike rates to over 5%, and yet the economy is still strong. Unemployment is low, and GDP growth is above trend. So it seems, if you're open-minded, you have to come to see that maybe something is different in the economy. Maybe the economy is less interest rate sensitive than expected. And you can see this in the distribution of R star among FOMC participants. Now, the median estimate of where R star is still 0.5% in real terms, but you can see from this dot plot that the distribution is widening towards the upside. So more and more people on the FOMC are beginning to think that, maybe that something in the world is different. And so interest rates going forward in the future are going to be structurally higher. They're becoming aware of the fact that that era of low interest rates that we had in the past, where people can get 2.5% mortgages, that's over. And going forward, maybe we're going to head towards a world where interest rates will be structurally higher. And again, if you follow my programming, then you know that that's what I've been saying for some time. The bond bull market is over, totally over. And going forward, we're basically very likely, in my view, to have structurally higher interest rates. The market, I think, is beginning to realize that. We see that today. And I think through the dot plots, we also see that the Fed is beginning to realize that as well. And yeah, nothing too much happened during the press conference, nothing really to write home about. So I think that's all I'll talk about. And I'll see you back here on Saturday, where I have my weekly markets briefing. Talk to you guys later.